Hi there, and thank you for joining today's webinar on Hedging 101, Managing Currency in Volatile Markets. It's great to have so many of you online. We are overwhelmed by the response and understand that many customers and businesses that are transacting overseas are feeling the pressure of market volatility, with increasing political instability impacting the currency markets. A recording of today's webinar will be sent to all attendees along with the slides post the session. Please keep a record of these to claim your CPD points as part of your 20 hours learning. So just an introduction to the speakers. My name is Jonathan Sermon. I'm joined by our Global Treasury Manager, Sebastian Schinkel. I've actually been with OFX since 2010. I've been working in foreign exchange for over 15 years across the UK and Australasia. And actually look after a lot of the CPA members. So we've worked with you guys since 2016 and have well over 1,000 members using us and referring your clients. Sebastian.
Hello, everyone. I have more than 7 years of FX trading experience in developing markets, where I was the head of FX for BBA Group in Peru. I came to Australia to study a master's degree and ended up falling in love with Sydney. I've been in OFX since 2017. I'm currently managing a team of treasury dealers across Sydney, Toronto, and London. We are in charge of hedging the company foreign exchange risk and liquidity.
Excellent. Thank you, Sebastian. So in today's session, we're going to take you through the different types of currency risk exposure and explain what this actually means when you or your clients are making or receiving international payments. To help you in having these conversations with your clients or business partners, I'll be giving you some tools that you can use to mitigate any foreign exchange risk. Sebastian will then jump in to give us an update on what's happening in the global markets, the outlook for the Aussie dollar, and some of the key currency trading corridors. Of course, if you have any questions as we go through the webinar, please send them across using the widget you should be seeing on your screen. We'll do our best to answer as many of these as we go along, and for the ones we don't get to, we'll follow up with you after the session. In the widget, you'll also find some helpful handouts on currency hedging products. With that said, let's get into it. Now, what is foreign exchange risk? When a business starts dealing in more than one currency, it faces foreign exchange or FX risk. This is when a business's financial performance or position will be affected by fluctuations in the exchange rates between currencies. For example, if you have an Aussie-based importer who is making payments to their supplier in China, they will most likely be affected by movements in the Aussie dollar, the US dollar, or CNY. And depending where they've prepared their budgets, this could have an impact on their bottom line. So when it comes to understanding the types of risk, we tend to bucket these into three buckets. You have transaction risk, economic risk, and translation risk. So transaction risk is the risk a company faces when it's buying or selling a product from a company located in another country. So let's go back to our Aussie importer. They receive an invoice in US dollars from their supplier in China that needs to be settled in 30 days. While they know the price in US dollars, they won't know the cost in Aussie dollars until they make the payment. So depending on what happens in that 30 days could mean that they pay more or less for the same amount of US dollars. When looking at economic risk, this is also known as forecast risk. And this is when a company's market value is impacted by unavoidable exposure to currency fluctuations. So let's say we have an Australian headquartered business that has 100 offshore staff. They could be manufacturing goods or VAs in Indonesia and Malaysia. The staff are paid in their local currency, and therefore when these currencies increase in value against the Aussie dollar, the cost base for the Australian company increases, which has the potential to impact the company's market value. And finally, we have translation risk. This is if a company has revenue lines that differ from its reporting currency, which is translation risk. Now, to help illustrate this, we wanted to show you some real-life examples where even at the big end of town, sometimes get it wrong. Unilever was hit with translation risk in 2018 when currency translation decreased the company turnover 8.9% according to an earnings transcript. This was on the back of the euro strengthening against all of the major currency corridors. A slightly more extreme case of unhedged currency exposure comes from Apple, a name I think we're all familiar with, in 2015, when its revenues were demolished by the strengthening of the US dollar. Currency fluctuations reduced Apple's revenue by 5%, a cool $3.73 billion US dollars. Now, in that quarter, Apple lost more money to currency fluctuations than Google makes in a quarter. So a few other things that happen when risk is managed badly. You can have financial instability. This is not knowing your company's financial situation or exposure when trading or doing business internationally. This can sometimes lead to the delay in key investment decisions. So if you're looking to expand overseas or unsure on what impacts the FX market will have on your bottom line, this may ultimately delay a product launch or purchase of premises. We've also heard about margin compressions. This can be where perhaps an importer or exporter is factoring in a 10% profit margin, which can be easily eroded due to currency volatility. So when talking to your clients, it's important to understand their tolerance to risk. So when talking about hedging strategies with your clients, understanding their tolerance to risk and even measuring their exposure. This will help you both make more informed decisions. Things we can think about around the checklist are hedging a certain percentage of all known exposures. What is mandated for the business? What is flexible when it comes to making their payments? You can also look at identifying the break-even levels, i.e., at what exchange rates does the client's business start to lose money, and where are they profitable? You can determine the sensitivity threshold to an overseas cost base. This is coming back to my comments earlier around economic risk, where we spoke about having employees or manufacturing offshore. And you can also start to set established levels of participation. Are there levels that your clients are happy to buy or sell in order to lock in profits or protect themselves? A common tool for this is limit orders, which I'll come back to later on. So there are many accounting practices that can measure foreign exchange risk. Most simply, it can be done through a register of exposures and the associated foreign exchange hedges. This is where the details of each hedge are recorded against its relevant exposure. This type of approach may also assist with compliance with accounting strategies for hedging, such as the AASB 9, Accounting Policy and Australian Accounting Standards Financial Instruments. We won't cover the others, as our value comes in supporting you with products and market expertise that enable you to build a simple currency plan and manage your clients' foreign exchange risk. Some other common mistakes we come across when hedging are unclear risk management objectives. The emotional versus the strategic decisions, when clients simply want this rate or want this margin. It's not uncommon for people to overhedge their positions, i.e. don't fix more than you need. There's no point fixing a $200,000 payment if your invoice is only $100,000 or $50,000. And also underestimating the full cost of hedging. What is the cost of sitting back and actually doing nothing? We often hear, I wish I'd have done something back when the rate was. Overuse of complex derivatives and a lack of situational awareness. If you or your clients are doing business with another country, things happen in that country will have an impact on your business and your bottom line. I'm going to pass over to Sebastian, who's going to give us a global and domestic market update.
Okay, so global markets basically continue to move back and forth as various geopolitical themes and new economic data is released. But overall, the key topics remain the same. We have the US-China trade war, Brexit, low yields, and global growth concerns. And then we also have Trump tweets, which are keeping financial markets on their toes. At the Treasury team, we look at graphs all day, and probably this won't excite you guys as much, but I'll try to simplify it a little bit. So as you can see on the left graph, volatility has been picking up. Volatility generally translates into a higher cost for hedging, but in general terms is just a measure of how assets move unpredictably. So we saw a spike in volatility at the end of July, following Trump announcement of more tariffs from September 1st. China then let the yuan devalue and mentioned they'll retaliate to any U.S. tariffs. The U.S. then followed through, calling China a currency manipulator. And in general, things got very tricky, and we saw corrections like big drops in equity indexes across the world, and treasury yields and yields across the world drop into new lows for a decade. Now, volatility is now trending lower, as it seems like Trump is willing to make some concessions to tariffs and other Chinese companies like Huawei. But in general, as we can see on the graph, volatility on the red line is defined against equities, but on the other lines there's also a pickup on FX volatility. On the right-hand side, we also have a graph where the USD is represented on the dotted black line, which, if you see it from the start from the graph, it doesn't seem like the USD has moved too much from today back 4 months ago. But as you can see on the graph, all the other currencies against the USD have been moving quite a bit. So the USD is proving to be very resilient despite the Fed cutting rates back in July. This is because the USD is measured against a basket of currencies, as I just mentioned. So in the last 4 months, we can see the JPY and the Swiss franc, which are the general safe haven currencies, trading much stronger, which is logical based on what has been happening on the markets. Then we have the GBP, which is the blue line at the bottom, is obviously trading lower based on all the Brexit drama. We have the euro basically trading flat against the USD on the last couple of months. We'll touch on the euro in a little bit. And then we can see the red and white and yellow line are the CNH and the Aussie currencies. So basically, back in July, when the currency war escalated, the CNH or the Chinese currency devalued, and the Aussie followed through, as they have been having a strong correlation in the last couple of months. So on the bottom graph, we can also see what we will expect from different scenarios on this global war. But in general, we see volatility staying at high levels if the trade war keeps going as it is. And basically, if we get a deal, we will probably see an improvement in the CNH and the Aussie dollar. Another measure of the amount of change we've been experiencing comes from the Fed rate cut probabilities. Back at the end of July, the market was pricing basically 0% chances for a 50 basis point rate cut. Now those chances are around 40%. So things have been changing quite a bit lately, and the same has happened in the local market with the Aussie dollar. So the Aussie, as I mentioned earlier, has been heavily impacted by the US-China trade war. as it has been highly correlated with the Chinese currency. But in the last couple of months, it's been able to hold above the 67.50 support. Given the recent spike in iron ore prices and evidence that the RBA rate cuts are helping the economy, at least from a housing and job market perspective, the Aussie has the potential to spike from these levels if the US and China sign a deal. On the graph, we can see different variables affecting the Aussie, which is the dotted line. But basically, you can see a strong correlation with the CNH currency and with a couple of commodities there, that's copper and iron ore. Against other currencies, that Aussie has had, I guess, a bit of a different evolution. But the important thing here is that if the trade war escalates farther, the CNH will probably devalue, and this will see the Aussie drop to new decade lows. We will be probably talking about the 0.65 next support level. So I guess in general, there are arguments for either side, all dependent on what happens with US-China, which just shows you how the market is now moving based on headlines. The AU market has also been moving up quite a bit from a rate cut probabilities. Back in a couple of weeks ago, the market was pricing 70% of probabilities for a rate cut. Following last week, a strong job report, now the probability is lower than 20%. When we talk about the Aussie against other major currencies, we can see it has traded pretty well against the euro. We can see the Aussie trading pretty well against the euro. The euro hasn't been doing pretty well since last week. It was reported that Germany is ready for deficit spending if recessions risk increase. The finance minister suggested Germany could use 50 billion euros to fiscal stimulus. The interesting bit here is how other countries like Italy and Greece will react, as Germany has been preaching austerity for the last 20 years, that now they're talking about deficit spending as a solution. Against the GDP, even if a no-deal Brexit is avoided on October 31st, there is now a high chance of an early general election, and the next move on the GBP will depend on those results. A big drop in the pound, putting the Aussie pound back above 0.60, is probably expected if an election then leads quickly to a no-deal Brexit. In the case of the Aussie and the Kiwi dollar, the Royal Bank of New Zealand and RBA cash rates are now aligned and are probably expected to follow each other with 25 basis point rate cuts projected for the end of the year. So just a representation of how these movements can potentially impact any company or any individual. We have there an exercise there which basically just shows you that if you were to buy $100K of US, it will have cost you back in April only 138K Aussie, but now that costs you more than 8K more. So there has been a lot of volatility, not only in the Aussie dollar, but in all the major currencies across the world. And this will definitely have an impact on how companies hedge or protect their finances. From events to watch in the next couple of weeks, we thought it was a good idea to share some of these important events. We have Jackson Hole Symposium on August 23rd, so at the end of this week. Fed Chairman Jerome Powell will kick off. And remember the Fed cut rates in July, and Powell labeled that cut as a mid-cycle adjustment. But since then, the US-China trade war escalated, and the market is pricing further rate cuts now. So probably for the USD to weaken, he will need to be very pessimistic, especially because other central bankers have been cutting aggressively in the last month. So Royal Bank of New Zealand, India, Thailand, RBA, and others. So the meeting will also give us an insight on who backed Powell's decision for a cut, who wanted it to be rather the start of a long easing cut cycle, and why there were some dissenters who didn't even want a cut. Then we have on September 1st, it's the official date for US to impose further tariffs on China. Then in the first week of September, we'll have central banks like the RBA, the ECB, the US Fed, and Bank of Japan all meeting. And then for the local market, we have Australia retail sales on September 3rd and the GDP on September 4th. I think these are going to be very important because the solid employment data from a couple of weeks ago has been supporting the AUD. But I think more important for the RBA now and the AUD going forward will be whether this shows up in consumption. So July retail sales and GDP will be key. So keep an eye on those. And now pass it back to John.
Well, thanks, Sebastian. That's a lot to be across there. Thank you for the update, especially when you can be 8,000 Aussie dollars better or worse off in the space of just a few months. Now, to help you when speaking with your clients about managing currency risk, I'm going to talk you through and give you a quick overview of some tools available that we come across. So you'd see on the screen, you've got a spot rate or a spot transfer. Now, this can be someone like me, for example, an expat sending money home to my parents in the UK, ad hoc transfers, ad hoc payments, or it could be an importer or an exporter that's making payments overseas as well for equipment or to some suppliers. Something we come across a lot with Australian businesses is paying VAs overseas as well, perhaps in Malaysia and the Philippines as well. When we look at the forward exchange contract, this is very much you buy the currency now, pay for it later on, and you fix that rate of exchange from the outset. So we spoke about margin compressions earlier on. This would help remove that risk. So again, going back to perhaps the Aussie business, they might be buying some equipment from overseas. It's a one-off purchase. To give them the confidence to know the cost of what it's going to be for them in Aussie dollars, they might fix that exchange rate at the start of their financial year, knowing they're going to purchase it at a later stage in that year. A popular one is a limit order for a lot of our corporate clients. This is almost a set and forget. This is where they use their OFX experts. We mentioned levels of participation. Once we have an understanding about the client's levels of participation, they might give us those target rates to hit, and we can set a limit order in place. And if those levels hit, we can go ahead and buy that currency on their behalf. Therefore, they can get on with business and their day-to-day, leaving us to look after the rest. And finally, we have FX options. This is the right, but not the obligation to sell your currency at a set price. Now, when you start to think about how your clients can use these products, as their trusted advisor, you can start to think about some of the steps that we've been discussing earlier on in the presentation. What does the business or what does the client's exposure to foreign exchange look like over the next 12 months? What is the risk appetite of your clients, of the business stakeholders? And what are the business objectives and desired participation rates? When can we help them lock in profits and mitigate any risk? And to perhaps give you an example of this, let's say we have a business with a low threshold for currency risk, where even the smallest movements in the Aussie dollar can mean a big hit to their bottom line. They might want to lock in a forward contract rate on 80% of their foreign exchange needs for that 12 months, and then manage the remaining 20% through spot transfers, allowing them to benefit from potential upside in the market. But don't forget, OFX is here to support you and your clients through this and tailor a strategy accordingly. So there are several ways to keep up to date with any market movements. Staying on top of market events and key drivers that cause markets to be volatile, such as inflation rates, interest rate announcements, monetary policy and economic performance announcements, and even events impacting geopolitical stability. Sebastian mentioned a few of these earlier on in his market update. As mentioned, understanding your clients' break-even points and understanding at what rates of exchange you and your clients are comfortable in operating in, remembering the tools we spoke about earlier on. Now, OFX has several tools available to help you and your clients when navigating the ever-changing currency markets. You can download our mobile app, sign up to rate alerts yourself, subscribe to our daily and weekly market commentary. But most of all, and most importantly, use our global team of OFX experts. You can also request a copy of our latest currency review to peruse as well. Now, I mentioned we've been partnering with the CPA since 2016. There might be a few of you that don't know much about OFX. In essence, we take out the stress of foreign exchange and help individuals and businesses develop and manage a simple currency strategy, particularly when it comes to the markets. With over 20 years of experience, we have a dedicated team of specialists supporting over 1 million customers worldwide. We offer bank-beating exchange rates, best-in-class service, and the right market insight tools to help you and your clients plan with confidence. And with our global footprint, we have local human specialist support available 24 hours a day, 7 days a week, with our follow-the-sun customer service model. Meaning when Sydney logs off, our London office takes over, followed by North America, which enables us to put your customers at the heart of everything we do. Remember, as a CPA member, you can sign up to receive bank-beating exchange rates, and all OFX transfer fees will be waived. To find out more about your CPA member benefits, head to ofx.com/CPA-Australia. You can also request a meeting with your dedicated account manager, Albert Ton, to find out how we can support you and your clients. And don't forget to get social. We're on all the usual channels, and you can find us at OFX. So we're now going to open up some questions that we've got through. One of the questions here is, can I recommend OFX to my clients that are not in Australia? The answer to this is yes. OFX is a global company that helps individuals and businesses transfer money to 190 countries across 55 currencies. If you have clients that are not domiciled in Australia, we can introduce them to our counterparts in their local region. We've got another question here. How do you recommend you could use a combination of forward contracts and spot transfers? So touching on what I spoke on earlier, using a combination of both forward exchange contracts and spot transfers allows you both to protect against unfavorable market movements by hedging a certain percentage of your exposure, for example, 60%, leaving the remaining 40% to take advantage of preferential market conditions should the market swing in your favor. Going back to our earlier example of the importer, you would be safe in the knowledge that your margins are protected against negative movements and you remain competitively priced in your local market.
We've got a really good question here from Anthony Williams. I'm just going to read the question. With some warning signs about the U.S. economy and additional uncertainty from a deepening of the trade war, in the event that there was a major global economic downturn, do you think that the USD will remain the currency of flight? What alternatives are there? Is there any chance that cryptocurrencies could start to serve this purpose? I think there's a really good case for cryptocurrencies in this scenario, because even though there are no assets that are backing cryptocurrencies at the moment, basically global stocks, bonds, and currencies are already trading at really extreme levels. The other asset that is really important in these type of scenarios is gold, and you probably are reading all the headlines around gold. The main question, and it's a really hard question to answer, is if things get really tricky, will the USD hold its flight to safety status? And it depends on how that correction happens. But generally, when you see a stress in global markets, people tend to jump into the USD. But in the past, when we've seen big corrections, even though the USD gets supported at the start, it might also happen that the USD gets dumped afterwards, especially given the twin deficits that the US economy is holding at the moment. So I wouldn't be surprised if people jump out of the USD. And when we saw that correction back 1 week ago, I was surprised to see a lot of demand for euros and JPY. Basically, well, JPY is classical, but in the case of the euro, it just shows you that the market will probably be looking for all the alternatives and not only focusing on the USD. Sorry.
Okay, we've got a question here from Basil John. I hope I pronounced that correctly, Basil. Where does the trust start between a company and OFX or similar company? In a time of high online scams, how does a company trust transferring large sums of money to using other companies outside of the bank? Great question, Basil. We get this a lot. So with regards to OFX, we have been doing this for well over 20 years. We are a listed entity on the ASX, and we do this all the time for our customers. We combine that element of individuals and also tech as well, which enables us to, one, track all our payments and track all the transfers, but two, pass on that level of service to people that do want to have a conversation with someone. In terms of how it works from a process side of things, we don't book any transfers unless we're instructed to by our clients. And then everything is trackable and traceable from within our banking network. So I hope that answers your question. Are there any more questions, guys, before we log off? Okay, perfect. Well, thank you very much for joining. If you do have any questions or you'd like to get in contact, don't forget to get social on our usual channels, or you can go to the member benefits website at CPA and get in contact with us there. Thanks very much for your time. We look forward to working with you.
Thank you.